Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. Today, we're doing a deep dive into, well, a whole stack of fascinating headlines hot off the presses Friday, June 27th, 2025. We're talking Yahoo Finance, CNBC, Bloomberg, Reuters.
All the big ones.
Exactly. And our mission today is really to cut through all that noise, get to the core of what's actually moving global markets.
From trade policies, which are constantly shifting, it seems.
Right, to the really intriguing dynamics playing out with the Federal Reserve.
It's a complex picture, definitely. Policy, power, market reactions, all tangled up.
So let's try and unpack it for you. Let's get into it. Okay, first up, the big story this week feels like it's been this intense back and forth on global trade, particularly with China. What's the real story here? I mean, we saw headlines about a confirmed trade framework.
Yeah, that's right. What's really jumping out, especially from reports on CNBC, is this confirmation of let's call it a framework between the U.S. and China. China's Ministry of Commerce says Beijing will review and approve export applications for controlled items.
Okay.
And in return, the U.S. will cancel some existing restrictive measures. Now, this apparently follows those talks in London.
Ah, right. The one's meant to stabilize things.
Exactly. Stabilize what's been, let's be honest, a pretty fraught relationship. But the key insight here, I think, is that while it sounds promising, it suggests more of a tentative stability, maybe a pause in tensions, not really a full resolution.
So a cautious step then, not a full-blown return to open trade.
Precisely.
But then there's this rare earths angle in the deal. It still seems a bit fuzzy on the details. Why is that specific ambiguity so telling?
Yeah, Bloomberg highlighted that. The deal reportedly includes China delivering rare earths to the U.S.
Which sounds good on the surface.
It does sound encouraging, yeah. But experts like Alfredo Montúfar-Hilú from the Conference Board, they're tempering expectations. They point out there's just no clarity on which specific rare earth export curves China will actually relax.
Ah, so the devil's in the non-details, almost.
Kind of, yeah, or the lack of them. That ambiguity around which curbs get relaxed really exposes the deep strategic mistrust that's still there. This isn't just about parts of your phone. It's about national security concerns playing out directly in economic policy.
So even a deal can be more symbolic if the core strategic stuff stays off limits.
Exactly. It might not change the substantive reality much.
Okay, shifting slightly but sticking with trade, what about the broader tariff picture? We keep hearing this phrase, Liberation Day tariffs. What exactly are those, and what's the latest on the deadlines we've been hearing about?
Right, that term pops up, often linked to specific U.S. policies targeting perceived trade imbalances. We saw mentions in Yahoo Finance and Bloomberg. White House Press Secretary Caroline Leavitt, she indicated that the July 9th deadline for these, quote, reciprocal tariffs might actually be extended.
Oh, interesting.
Yeah, she said the deadlines are not critical, and President Trump has even hinted at, imminent top 10 deals coming with major trading partners.
So maybe some flexibility there.
Maybe. But there's also this widely recognized sort of disorganized approach to the whole tariff policy landscape. And that's definitely causing a lot of uncertainty for businesses trying to plan ahead.
Okay, so with all that policy uncertainty, maybe new tariffs coming, maybe not. How are actual businesses and maybe consumers like you feeling the squeeze? Can you give us some real-world examples?
Oh, absolutely. This is where it gets really tangible, and we saw reports on this from both CNBC and Yahoo Finance. Take Nike, for example.
Right, big global player.
Huge. They're expecting a potential hit of, get this, $1 billion from tariffs just this fiscal year.
Wow, $1 billion.
Yeah. So their strategy, they're tweaking supply chains, trying to move things around, and, increasing prices to offset some of that cost. Right now, they get about 16% of their stuff from China, but they're aiming to bring that down to high single digits.
Okay, that makes sense. But you said their stock was up.
Yeah, interestingly, their stock actually ticked up after hours despite this news, which suggests maybe investors thought the hit could have been even worse, or they liked the plan.
Okay, what about other sectors? Cars.
The auto sector, yeah. Analysts at Cox Automotive are predicting price hikes are definitely coming for new cars, mainly because supply is dwindling.
Dwindling how much?
Well, the industry's supply of new vehicles dropped from 92 days worth back in March to just 70 days in June. That's a pretty significant fall.
Yeah, that's quick. And what about, say, toys? We heard something about that, too.
Oh, yeah. Toys are feeling it already. Prices are rising significantly. The Washington Post noted the price of toys, games, playground equipment, it jumped a record 2.2% just between April and May.
Just in 1 month. Wow.
Right. And there was this anecdote about a Chinese toy maker who, like, frantically moved production molds to Vietnam to dodge tariffs,
Okay.
only to have to rush them back to China when tariffs were temporarily lowered.
Oh, man. Talk about whiplash.
Exactly. It just highlights the crazy agility and, frankly, the massive headache manufacturers are dealing with right now. Supply chain gymnastics, as you said.
So what does this mean for the bigger picture, the broader economy?
Well, there are warnings. JP Morgan analysts, for instance, are warning about a potential stagflationary slowdown in the U.S. They put a 40% chance on a recession in the second half of 2025, largely blaming these higher tariffs.
Stagflationary, slower growth and higher prices. Not ideal.
Definitely not. But then on the flip side, President Trump's tariffs. They are bringing in billions more for the U.S. government. Treasury data shows June might even set another monthly record for customs duty revenue.
So it's a real paradox, isn't it? More money coming into the government, but potentially slowing down the economy overall.
It really highlights the trade-offs involved. Very
Yeah.
complex.
Absolutely. So how are other countries reacting to all this? Are they just, taking it on the chin? Or are they pushing back?
Oh, they're definitely pushing back in various ways. Bloomberg reported Japan, for instance, is sticking to its guns. They're reiterating they just cannot accept 25% tariffs on cars.
And their reasoning.
They emphasize, look, our automakers actually build significantly more cars inside the U.S. than they export to the U.S.
That's a key point.
It is. And then we saw President Trump publicly calling out Spain for not meeting NATO spending targets.
Right, I saw that headline.
And threatened to double their tariffs.
Yeah.
And within the EU itself, there's this ongoing debate. Should they strike a quick trade deal with the U.S., even if it's maybe not perfectly balanced, or should they hold out for better terms?
So divisions within the EU, too.
Clear divisions, yeah.
Yeah.
Like Paris pushing hard for complete tariff removal from the U.S. side before any deal. It's really testing their unity and their strategic patience, you know.
Definitely a global chess game. Okay, let's shift gears. Let's talk about something that touches every part of the economy, the Federal Reserve. The chatter about who might lead the Fed next seems unusually loud, even though Jerome Powell's term isn't up until May 2026. What's driving all this early speculation?
Well, a key factor, and Yahoo Finance detailed this pretty well, seems to be President Trump's growing impatience.
Impatience with what, specifically?
With Powell's current wait-and-see approach on interest rates, Stephen Moore, who's been a longtime Trump advisor, even suggested that announcing a potential successor early would be like a shot across the bow at Powell.
So using the appointment process as leverage on current policy.
It certainly looks that way. It's a way to signal dissatisfaction and maybe pressure the Fed towards the administration's preferred path, which is lower rates.
Okay, so who are the names being floated then? Who's on this supposed short list, and what kind of different directions might they represent for monetary policy?
Right, so Yahoo Finance laid out a few names, and what's really interesting isn't just who they are, but what the type of person suggests about what the White House wants in a Fed chair.
Which seems to be
Someone who prioritizes immediate economic growth, likely through lower interest rates, perhaps even if that means stepping away a bit from the Fed's traditional independence.
Gotcha. So who's on the list?
Okay, first there's Kevin Warsh. He's a former Fed governor, was actually Bernanke's main link to Wall Street during the 2008 crisis. He's been critical of the Fed recently, calling for a strategic reset. He aligns with the White House on some tariff views, but he has made some more hawkish comments on inflation in the past.
Which might not sit well if the goal is lower rates.
Exactly. And reportedly, the president is kind of souring on him anyway.
Okay, who else?
Then you have Chris Waller. He's currently a Fed governor. He was actually the first Fed policymaker to openly call for lower rates back in July. And he seems to agree with the White House view that any inflation from tariffs won't be persistent, it'll be temporary.
So he sounds aligned.
On paper, maybe. But his candidacy is reportedly hurt because he voted with Powell to keep rates on hold at the last meeting.
Ah, okay. Loyalty test, maybe.
Could be. Then there's Scott Bessent, the current Treasury Secretary. He says he loves his job, wants to stay through 2029, but he did previously float this idea of a shadow chair for the Fed, which sort of implied Powell would lose influence even if he stayed.
Interesting phrasing.
Yeah. Bessent acknowledges tariffs might cause a one-time price bump, but he also refutes the idea of persistent inflation from them.
Okay, next.
David Malpass, former World Bank president. He's been pushing for lower rates for months now, explicitly to boost growth. He argued, quote, "The Fed is really important to growth, and Trump is right that we've got to have lower interest rates." Pretty direct.
Very direct. Anyone else?
Last one mentioned is Kevin Hassett. He's the National Economic Council director, so he has a close relationship with Trump. He initially focused more on bond yields, but lately he's been very explicit, saying things like, there is no reason at all for the Fed not to cut rates right now.
Also quite direct.
Very. However, the Wall Street Journal reported just this week that Hassett apparently isn't actually interested in the Fed job. So maybe he's out of the running.
So it's a real mix, but the overall signal seems clear about what the White House wants.
Definitely seems that way.
But what's the Fed actually saying and doing right now? What's Powell's current stance, especially with all these tariff concerns swirling?
Well, Powell himself, he reiterated the Fed's wait-and-see approach just this week. He specifically mentioned needing to see how tariffs impact the economy. He told Congress he's wary that higher tariffs could start pushing inflation up again.
So he's acknowledging the risk.
He is, but at the same time, if you look at the markets, Reuters and CNBC reported that Fed fund futures, basically where traders bet on future rates, they're showing ramped up bets for more easing this year.
Oh, really? So the market thinks cuts are coming anyway.
Yeah, traders are now pricing in about a 20% chance of a rate cut happening as soon as July. That's up from just 12.5% last week.
Okay, that's a jump.
It is. And everyone's waiting for the key inflation data, the PCE report for May. Economists expect that to show headline inflation ticking up slightly to 2.3%, core inflation maybe to 2.6%.
So that report coming out soon is going to be really crucial for you, the listener, to watch. It directly impacts how the Fed might move and ultimately your borrowing costs, your savings rates.
Absolutely. It's a big piece of the puzzle.
Okay, so with all these moving parts, trade tensions, Fed speculation, tariff impacts, how are the actual markets digesting all this? Are they nervous, bracing for impact, or just shrugging it off? U.S. stocks seem incredibly resilient.
It's quite striking, isn't it? As highlighted by CNBC and Reuters, U.S. stock markets seem, well, remarkably resilient is the right word. The S&P 500 is like a whisker away from a new record high. It's up almost 3% just this week.
Wow.
And the NASDAQ composite also inches away from a new record. Futures for both indexes actually hit new records this morning.
Incredible. And didn't UBS raise their target?
They did. UBS Global Wealth Management raised its year-end target for the S&P 500. They bumped it up to 6,200 from 6,000.
And their reasoning?
They're banking on trade tension softening. That was according to Reuters.
So it feels like Wall Street is just, as one source put it, totally unbothered, almost cheeky about it. What's really driving this calm amidst all the noise?
Yeah, totally unbothered was the phrase CNBC used. And part of that chilled out mood, as they called it, is definitely rate cut optimism creeping back in.
Ah, okay. The market betting on the Fed easing.
Exactly. Plus, oil prices dropped recently, which took some immediate inflation pressure off the table. Bond yields eased back a bit, and risk appetite just seemed to return.
And it's not just a few tech stocks driving it.
Well, Jim Cramer on CNBC made that point. He argued against the idea that the rally was too narrow, pointing to gains across a broad group of stocks. He mentioned diverse names like Enphase Energy and Solar, Freeport-McMoRan and Copper, even Coinbase in crypto.
So a wider participation.
Demonstrating a real broad bullish rally, as he put it. It's almost like the market has developed this thick skin to the geopolitical headlines, you know? You expect volatility, but it just keeps cruising.
Huh. Okay, what about other indicators? The dollar, corporate earnings. Are they reinforcing this optimistic view?
They seem to be, yeah. The dollar index, according to CNBC, was down for 5 straight days, hitting lows we haven't seen since March 2022.
And that's generally good for...
Good for U.S. exporters, generally. Makes their products cheaper overseas. Think companies like Chevron or Amazon.
Right. And earnings?
Corporate earnings have held up pretty well, too. FactSet data showed S&P 500 earnings grew by about 4.9% in the second quarter. That marks the 8th consecutive quarter of year-over-year growth.
8 quarters in a row. That's consistent.
It's a solid run of positive performance, definitely underpinning some of that market strength.
Okay, let's step outside the U.S. for a moment. What's the pulse in Asia-Pacific markets today? Are they mirroring this resilience, or are we seeing a different story over there?
It was more of a mixed picture in Asia-Pacific on Friday, based on CNBC reports. A bit more nuanced.
Okay, like what?
Well, in China, industrial profits actually fell 9.1% year-on-year for the first 5 months. That's the largest monthly decline since last October. So that's a clear headwind.
Right, not great news there.
But at the same time, you saw shares of Xiaomi listed in Hong Kong surge nearly 8% to a record high.
Xiaomi, why the jump?
They launched a new luxury electric SUV, priced lower than Tesla's Model Y. So huge investor excitement there. A fascinating contrast within China itself.
Definitely. What about Japan?
Japan's Nikkei 225 actually closed at a 6-month high. It crossed the 40,000 mark for the first time since way back in January.
So strong performance there.
Yeah, but underneath that, Tokyo's core consumer price index rose at a slower pace in June, and Japan's retail sales saw their slowest rise in 3 months. So again, a bit of a mixed signal, strong market, but maybe some underlying economic softness.
A mixed bag across the region then. Okay, let's pivot now to the world of tech and AI. Always dynamic. We heard China is really pushing hard on its chip industry, trying to overcome those U.S. curbs. What's their new strategy there, and what does it tell us about the bigger tech race?
Yeah, Bloomberg had some key insights on this. China's huge state-backed chip investment fund, they call it Big Fund 3, is apparently switching tack.
Switching how?
It's reportedly refocusing its investments on very specific bottlenecks. Things like lithography systems, the super complex machines needed to make advanced chips, currently dominated by the Dutch firm ASML.
Ah, the choke points.
Exactly.
Yeah.
And also semiconductor design software, where U.S. companies like Cadence and Synopsys basically control the market. So the strategy is clearly aimed at overcoming these specific U.S. efforts to block China's technological progress, especially in cutting-edge AI. President Xi himself has declared eliminating these choke points a top national priority.
So this isn't just about catching up. It's a direct strategic countermove.
Absolutely. It's a battle for technological sovereignty, really.
Yeah.
It means the U.S.-China tech rivalry is far from over. It's just entering a new phase, maybe.
A monumental strategic investment. Okay, and staying with AI, we saw headlines about SoftBank and OpenAI. What's Masayoshi Son's big play here? Sounds like he's betting big.
Oh, all in is the phrase being used. SoftBank CEO Masayoshi Son, according to CNBC, has planned investments in OpenAI reaching about $33.2 billion.
$33 billion, wow.
Yeah. Son apparently believes OpenAI will eventually become the most valuable company in the world.
High expectations.
Very. And what's particularly interesting, maybe a bit cheeky, is Son revealed he actually wanted to be an early investor in OpenAI way back, but he lost out to Microsoft.
Oh, really?
Yeah. And now, with all these recent reports about a supposedly rocky relationship between Microsoft and OpenAI,
Right, we've seen those.
Son basically suggested OpenAI CEO Sam Altman should have picked SoftBank instead back then. A little bit of I told you so, maybe.
Huh, okay. And Son's bigger vision.
His vision goes way beyond just OpenAI. He wants SoftBank itself to become the biggest platform provider for what he calls artificial superintelligence, or ASI.
Super intelligent.
Yeah, AI that's like 10,000 times smarter than humans. He sees this happening within the next decade. And partnerships, like the one SoftBank has with chip designer ARM, are essential to that vision. He's thinking on a truly massive, almost sci-fi scale.
10,000 times smarter.
Wow.
Okay. Finally, let's quickly touch on oil. It's been a volatile week for energy markets. How are things looking now? Have they calmed down?
Yeah, oil prices have finally steadied a bit, according to Bloomberg. This comes after a week that saw one of the biggest weekly price drops in about 2 years.
And what caused the drop and then the steadying?
Well, the steadying seems linked to the ceasefire announced between Israel and Iran after nearly 2 weeks of conflict. That eased the immediate concerns about major supply disruptions from the Middle East.
Right, that geopolitical tension easing had a direct impact.
A very direct impact on prices, yeah.
And one persistent theme in oil is China's role, especially regarding Iranian oil. Despite U.S. sanctions, how are they managing to keep importing so much?
That's right. It's a constant factor.
Yeah.
Despite U.S. sanctions targeting Tehran, China remains the #1 buyer of Iranian oil. And they do it using what's often called a shadow supply chain. CNBC detailed this. It involves things like ship-to-ship transfers of oil, often happening out at sea, maybe in the Strait of Malacca or off the coast of Malaysia.
Kind of hiding in plain sight.
Sort of. These areas are known hotspots for this kind of transshipment. Tankers even engage in spoofing, basically faking their GPS locations to mask where they've been and what they're doing.
Wow. And how do the payments work? They can't use dollars, right?
Exactly. Payments are typically made in Chinese yuan, bypassing the U.S. dollar-dominated SWIFT banking message system. That's the critical global network. And by avoiding it, they significantly blunt the impact of U.S. sanctions.
And why does China want Iranian oil so much? Is it just cheaper?
That's a big part of it. Experts note Iranian oil is often, $6 or $7 cheaper per barrel than other sources. That really attracts China's independent refineries. They call them teapots.
Teapots.
Yeah, they're not the big state-owned giants, so they have a bit more flexibility, maybe more incentive to use these alternative supply routes to get the cheaper crude. And the numbers show it. Iran's crude imports into China have just kept rising, nearly doubling between 2022 and 2024.
It really underscores the limits of sanctions when there's strong economic will and alternative ways to do business.
Absolutely. It's a constant cat and mouse game.
Well, what an incredible deep dive. We've covered so much ground today, trying to make sense of these forces shaping our financial world, from that intricate dance of trade talks and tariffs, and seeing the real impact on companies like Nike and automakers,
Right, and consumers too.
to the high-stakes game around Fed leadership and who might be next, and then seeing the surprising resilience in the U.S. stock market despite all the noise. It's clear these things are all interconnected, aren't they?
Absolutely.
Yeah.
You can't look at any one piece in isolation. The threads of geopolitics, monetary policy decisions, technological ambitions like China's chip strategy or SoftBank's AI bets, they're constantly weaving together. It creates this really dynamic environment where shifts can happen fast and have big consequences. Trying to observe how these elements interact, that gives you, the listener, a much clearer picture of where the economy might actually be headed.
And that's really what we try to do here in the deep dive, right? Help you connect those dots, maybe uncover some surprising insights along the way, and just help you feel genuinely well-informed. So as you reflect on everything we've talked about today, here's maybe something to chew on. How might all these seemingly separate things, like a toy maker juggling molds, central bankers debating successors, a tech fund pivoting its investments, how might they all converge over the next few years to fundamentally redefine economic power, global competition, and the very supply chains that bring products to your door?
It's all connected, and the ripple effects are definitely just beginning. Lots to keep watching.
Indeed. We hope this deep dive has given you plenty to think about. We'll see you all Monday morning with new headlines from major financial magazines.